Hello, this is Kevin Prince from BMO Exchange Traded Funds. I'd like to say thank you again for joining us for the Market Insights webinar. Each week we try to dive into a topic. This week, we're going to actually spend some time and talk about liquidity. Now, when we announced that last week, we didn't realize how important the conversation liquidity was going to be with the, of course, GameStop activities in the marketplace. So we're going to dive into all the aspects of liquidity, but keep it tilted towards exchange traded funds. And ultimately, like as always, I want to thank people for sending in their questions because those questions help drive the content. So we're going to answer some of the key questions that came in this week a little later on. But with that, let's get started. First and foremost, a disclaimer. What do we say in our disclaimer? What we're trying to provide you here is insights to the market. That's not specific recommendations, nor is it specific advice. It's insights and overall across the marketplace. Let me introduce our guests today. Returning, Alfred Lee from BMO Global Asset Management, a portfolio manager in the team. But join us new this time, Jamie Karim from BMO Capital Markets. He's what we call a market maker. We're going to tell you what that means a little later on. And Jimmy actually is joining us live from the trading floor. Thank you for that, Jimmy. Thank you for that, Alfred. Now, people know who've been on this session before. We certainly start off with a tool. Because we're talking about liquidity, I want to bring up a tool we brought up in the past, and that tool is stockwatch.com. Why am I highlighting this tool for you to take a look at? Well, quite often when you're looking at an exchange traded fund and it's trading the marketplace, I will let you know a lot of the tools out there are only showing you one level of liquidity. What do I mean by that? You're probably just seeing the TMX. And if you're only seeing the TMX, you're missing a lot of what's going on behind the scenes at exchange traded funds. So for example, here I am showing you a more detailed quote. You know, the second line down there shows you TMX, but you're seeing all the other exchanges and them quoting, and then you see their volume there too in these ETFs. Now this is a screenshot of yesterday morning around 10 o'clock, and you can see in that ETF ZDB already, and the TMX has had 10,000 shares traded. But if you look collectively all the other exchanges, you see it's over 28,000. So when you're thinking about volume of an ETF, liquidity of an ETF, it is important when you think about that to look at the bigger picture, and stockwatch.com can let you see the bigger picture of all the exchanges at once. With that, let me reach into touch base with Alfred here to kick off. Now, Alfred, certainly saw last year being one of those big flow years for exchange traded funds out there. And of course, I want to highlight that BMO led the industry last year. But what I want to come to you about is, can you talk to us about some of the key themes? Because where the money is going to is also a concept of liquidity out there.
Yeah, for sure, Kevin. So, 2020, another banner year for the ETF industry in general. So I think last year was a good illustration in terms of how ETF are very good liquidity tools, right? So obviously last year in 2020, characterized by the sell-off caused by the coronavirus. So a lot of market volatility, but when investors want to get access to whatever asset class they want to get exposure to, ETFs are essentially the most efficient way of doing so. So fixed income, we essentially saw investors using fixed income ETFs as a way to get exposure to a market that is, very illiquid and not very transparent, but the ETF provides a lot of those advantages over and above the underlying market. And as I mentioned, in the equity market, a lot of people in April and March, where the market was selling off, they want to get exposure to those markets specifically right away. ETFs were the most efficient way of doing so. And one other trend I want to point out was commodities. As we saw reflationary pressures, as commodities started to outperform, commodity ETFs once again were started to become popular again, and once again because of investors wanting to get exposure to that area as quickly and as efficiently as possible.
Thanks for that, Alfred. And of course, when we're talking about liquidity, this is currently showing money coming in, but we're also talking about money being able to move out. Can you get in? Can you get out of that investment? And of course, we're going to talk specifically around ETFs here. Now, Alfred, let's just stay with you for a second, because in the concept of ETFs, there's a few myths that kind of frequently come up from time to time. Let's just quickly go through them and kind of use them as an overview of what the discussion we're going to dive into a little later on. So first and foremost, myth. trading activity impacts the underlying securities with an ETF? Yes or no? And what do you say about that, Alfred?
No. So, one thing to keep in mind is that when you trade an ETF, especially for more mature ETFs, which we're going to discuss later, most of the volume of an ETF occurs on the exchange, which is just buying and selling of the ETF units themselves. So very often, even though you see a lot of volume for an ETF, there's no impact on the underlying market, since it's just the buying and selling of the ETF units themselves without touching the underlying market.
And we got some good examples that come in later on. Let's talk about fixed income too, because quite often people think about fixed income. ETFs are getting too big and maybe a threat to the broad market. What do you say to that, Alfred?
So definitely not true as well. So when you look at the fixed income market itself is much bigger than the equity market. So that's one thing for investors to keep in mind. And ETFs, especially in the fixed income market, very different from equity-based ETFs, whereas when you have an equity ETF that tracks the S&P 500, it essentially holds all the 500 underlying constituents. A fixed income ETF is just a small sample of the fixed income market for each creation ETF. So very little impact to the underlying fixed income market as a whole.
And the last one here quickly, certainly, let's say an ETF doesn't have much volume, doesn't trade that much. Then somebody goes and trades that ETF. Is that going to drive the price of that ETF up distinctly different than the underlying?
No, because the ETF itself it's an open-ended vehicle similar to a mutual fund. So for a stock, the amount outstanding for a stock is fixed. For an ETF, that amount of supply is open-ended, similar to a mutual fund. So because of that changing supply, it's able to offset changes in demand.
Thanks for that, Alfred. Now, Jimmy, let's bring you into this because let's talk about the overall ETF ecosystem for trading. I mean, a lot of investors, when they're buying and selling ETFs, they think they're just like stocks. And of course, that is a key part of an ETF where it has the exchange, where the buyers and sellers meet naturally in the exchange. But there's a lot more to it when it comes to an ETF, specifically with your role as a market maker in that. We're going to define market maker in a little bit, but walk us through what else is going on behind the scenes beyond the exchange.
Yes, absolutely. So basically, the answer to the question really lies in the name ETF. So, it's an exchange traded fund. So there's two portions there. So if you look at the exchange traded portion, what does that mean? So Alfred did actually talk a bit about that. So basically, what that means is for more mature ETFs, you do have natural buyers and sellers that interact in the market. So in most instances, when an ETF is traded both ways, buying and selling, the flow naturally offsets itself. So as a market maker, my job is to post bids and offers all day, every day, and hopefully the buyer meets the seller, and then there's nothing really going on more than that in the background. But more often than none, we end up with positions, residual positions. And in that case, what happens, this is where the second portion of the name ETF comes into play, which is the F, which stands for fund. So in that case, what happens, we access a second level of liquidity. So what we would do in that case is we would actually source the underlying securities and go and talk to the issuer, so Alfred in this case, and actually issue more shares of the ETF in order to provide that liquidity to the market.
Thank you for that, Jimmy. And we're going to spend a little bit more time in a little bit talking about your role as market maker there, because I think it's a key part that maybe a lot of the participants in these webinars don't often hear about out there. Alfred, let me come to you, because when talking about liquidity, we mentioned that that it's based upon the underlying, but can you give us some examples and walk us through what do you mean by based upon the underlying?
Sure. So this is a good example. This is a slide that I often refer to because I think it's very simple and it's a good way to illustrate how the liquidity for an ETF is really determined by the underlying constituent. So taking ZEB, which is the BMO Equal Weight Bank ETF. So this is a good example of a very simple ETF that holds the big six underlying, or the big six Canadian banks equally weighted on a dollar value. So each creation basket, so when we create new shares with Jimmy, basically he has to create them at 100,000 units at a time. So each creation basket, if you assume a NAV of $29.30, that basket value is going to be worth $2.93 million. So each creation basket, that 2.93 million is going to be spread across those 6 different banks equally. But as you could see, even if this was a brand new ETF that did not trade, each creation basket, for BMO shares, it's a little bit less than 5,000 shares. BNS is going to be a little bit over 7,000 shares per creation basket. But when you compare to the ADV, which is the average daily volume, it's really just a fraction of the average daily volume for those shares. As we all know, Canadian banks are very heavily traded, one of the most heavily traded stocks on the Canadian exchange. And as a percentage of the average daily volume, as I mentioned, is just a drop in the bucket. So as a result of that, even if the ETF itself did not trade, multiple numbers or creation baskets of that ETF can be created, even if the ETF itself does not trade. So liquidity of an ETF is really determined by the underlying securities and not the volume of the ETF itself.
Thanks for that, Alfred. And then, Alfred, one interesting thing you brought to my attention is that as the ETF grows, there's almost a cycle of liquidity as it grows in assets across the board. Walk us through that, please.
Yeah, so a good example is, when you take a heavily traded ETF, such as the SPY, that trades down in the US, one of the most heavily traded securities in all of the world, right? So either ETF or stock. And when you look at it, it trades at a tighter bid-offer spread than the underlying securities. And the reason why is because, let's take, for example, when we launch an ETF. When we launch an ETF, that bid-offer spread is really dictated by the underlying basket. But what happens over the life of the ETF is that as investors start trading that ETF, volume is generated on that ETF. You have more market makers like Jimmy start stepping in that are attracted to that volume, and then they start posting a bid-offer spread. It gets more competitive as volume, additional volume is attracted to that ETF. So the market makers become more and more competitive, start posting tighter and tighter bid-offer spreads, and then with all that secondary volume, it creates not only a deeper order book, that bid-offer spread is going to be tighter as most of the trading activity is now going to occur on the secondary market, meaning that on the exchange, where at this point, when you're buying and selling an ETF, the likelihood is that you're just buying it off of an ETF buyer or seller. So very often when you have a very mature ETF, that bid-offer spread is going to be much tighter than the underlying basket. So corporate bonds is a very good example of this, where you look at the underlying corporate bond market, very wide bid-offer spreads. But when you look at corporate bond ETFs, the bid-offer spread is much tighter than the underlying market, which is why even a lot of large institutions use ETFs to get that exposure.
Thanks for that, Alfred. And I think one thing key to highlight there is I like the idea that we talk about from time to time that if you're looking for a key indication of liquidity of an ETF, well, that spread is a key indication of liquidity ETF, and this is actually showing how that spread can get even better and better over time because of the scale of the ETF growing. Now, let me come into you, Jimmy, for a second here, because I mentioned the concept of market maker. Again, it's probably new for a lot of people out there, and these are really the professionals in the industry that are buying and selling underlying securities, creating ETFs, and basically removing ETFs in the marketplace on a regular basis, because of course an ETF is an open-ended product. There's a lot of market makers in Canada. Most of the major banks have a market maker. Jimmy, talk to us about the role of the market maker. What is a market maker?
Yes, absolutely. And that's a very good question. So really, my role is a reflection of what the client is doing at the end of the day. And what I mean by that is, when you think about it, what are you doing when you're buying or selling an ETF? You're actually buying or selling a portfolio of underlying assets. So every time you are trading an ETF, and I am the other side of that trade, I have to look at that basket of underlying assets. So in a way, I am acting as the liaison between the client who's trading the ETFs, the ETF provider, BMO GAM in this case, and the actual underlying assets. So if you look at corporate bonds, for example, every time a client is buying or selling a corporate bond ETF, essentially what they are doing is they are trading with me a basket of hundreds, if not thousands, of corporate bonds. So what I would need to do in that case is 3 things. Well, one, try to see if I can find a natural offset for that ETF, i.e. match the buyer with an equivalent seller. Number two, I have to look at what is actually going on with the underlying assets. So what are these 1,000 corporate bonds doing? In essence, I am pricing live thousands and thousands of corporate bonds every day because I need these live prices to be able to price the ETFs. So I have to take that into account. And number three is I have to actually be in constant communication with the asset manager or the ETF provider. So in that sense, the role of a market maker is really the liaison between these three different components or three different market participants. And further than that, as a designated market maker, it's my obligation to continuously quote prices on the exchanges for all the ETFs. So an ETF price has to be visible and transactionable at all times.
Thanks for that, Jimmy. And I appreciate you walking us through with the core role of market makers for the audience here. Now, hand in hand with that, you mentioned Alfred there. Now, Alfred's a portfolio manager on ETFs. And some people think that, ETFs are run by computers. There's actually is portfolio managers that run the exchange traded funds and work with the market makers. Alfred, walk us through the role of a portfolio manager, please.
Sure. So I would say a portfolio manager on the ETF side, very different from your traditional active manager, whereas an active manager focuses on one specific part of an asset class. We focus on many different asset classes. So we are more kind of generalist, I would say, where we could be trading, emerging market bonds, credit derivatives, and then, treasuries. And then my colleagues will be trading, various parts of the equity market and then options. So we're more generalists. But, the bulk of our duties is, rebalancing the portfolio. Different ETFs will have different rebalancing schedules. Some of the equities will be semi-annual, whereas the fixed income ETFs will rebalance on a daily basis. But overall, our job is to track an index for the most part, whereas an active manager, they are trying to outperform an index. So very different objectives. But, to your point, I think a big part of our roles is interacting with the market makers, such as Jimmy. So we want to make sure that on a daily basis, the market makers have accurate data in order to make a market. We want to help clients facilitate liquidity as well. So if there's larger trades coming in, we are in constant discussions with the market makers to ensure that our clients have a very good experience trading our ETFs.
Thanks for that, Alfred. Now, building on the education piece here, let's talk about some real examples that actually happen in ETFs. Now, we're in the midst to start off with. We talked about, can large trades in ETFs move the market? And this is a great example, I think, and thanks for pulling it together, Alfred. This is a trade in our ETF ZFM, well over $100 million. Talk to us about this trade and what it did to the marketplace there.
Yeah, so when you look at this trade as an example, this is a good example of how volume of an ETF is not a good indication of liquidity for an ETF. So ZFM, for example, it's basically an ETF that holds midterm federal bonds, so a very liquid asset class. So on average, this ETF trades about 217,000 shares a day. We had a client, institutional client, that came in, wanted to trade over 10 million shares of this ETF. So I think that's about 50 times the average daily volume. But essentially, because the underlying asset class is extremely liquid, Jimmy could go out there and buy the underlying bonds and deliver it to us, no problem at all. So because of that, the client was able to buy, that $170 million worth of the underlying asset and basically get that trade with no impact to the underlying market at all.
And just so we don't say we have one example, let's just do the exact same thing on a separate example, a different date. In this case, now on our ZGB, our government bond ETF. And walk us through that, please, Alfred.
Yeah, so ZGB is, as you mentioned, the government bond ETF. So again, the underlying assets are extremely liquid, where it holds federal bonds and also provincial bonds as well. So very liquid. This ETF is a little bit newer. So we launched it, I think, about a year and a half, 2 years ago. On average, it trades about 52,000 shares a day. But a client wants to come in and execute 865,000 shares, which is roughly about 48 million. They want to do it, during the market hours. But essentially, they were able to do that trade which is, multiples above the average daily volume, no impact to the underlying market. So again, this is a good illustration of how volume of an ETF is not a good indicator of liquidity. It's the underlying asset class that really dictates the liquidity of an ETF.
Thanks for that. Thanks for the examples there, Alfred. Jamie, let me come back to you because, when we talk about ETFs, it's one of the myths around ETFs that maybe they won't be there to provide the liquidity during a market correction. It could impact the market. Talk to us about what happened more recently in the correction, what ETFs did during that period of time.
Yes, absolutely. And if I may as well, I just want to touch on something Alfred mentioned as well. Very great point there. So I just need to actually, add to that. When we talk about liquidity in ETFs versus volume of the traded ETF, if I were to simplify this, if I were to put liquidity as a function, I would say ETF liquidity is a direct function of the underlying asset class plus 2 layers of additional liquidity. And those 2 layers of additional liquidity, the first one is net new participants in the market, i.e. natural buyers and sellers of ETF. And the second additional layer of liquidity is the actual fund liquidity. So every time you are trading an ETF, there's a possibility that we go 2 levels up, right? So you're getting the benefit of that liquidity when you trade an ETF. And the reason I mention that is because if you look at what happened in March, essentially the underlying fixed income market totally froze. You could not sell any bonds, pretty much everything just kind of locked up, versus ETFs were still trading. In fact, there was a spike in volume in ETFs. When everything else froze, we still stood there and actually provided both bids and offers on fixed income ETFs and other ETFs. Now, the way we can do that is actually basically the first layer of liquidity, which is the underlying asset class, froze, but we still had the benefit of those 2 additional layers of liquidity I just mentioned. So even institutional clients that were, had never looked at ETFs before suddenly became big supporters, massive participants, and it was actually a very, very good proof of concept and proof that ETFs, even during stressful times, are there to stay and can provide that additional liquidity.
Thanks for that, Jimmy. And of course, I always like to highlight that, ETFs, the initial concept around exchange traded funds came out of the 87 correction to showcase and provide additional liquidity in the marketplace as a concept. And, fast forward now to the more recent correction, you can certainly see they did provide the liquidity in the marketplace, both on the equity side and, as you mentioned, the fixed income side too. Alfred, let me bring you in because Jimmy talked about fixed income, something near and dear to your heart. Talk to us about when the bond market locked back in the March period there and how that ETF kept trading through that period.
Yeah, so one of the highlights, or one of the things that a lot of investors brought up during the March sell-off is, fixed income ETFs, and they continued to trade where the underlying market didn't trade at all. One of the things that a lot of investors brought up was that why ETFs were trading at a steep discount or a discount to the net asset value. So the price basically disconnected from the net asset value. So the reason why is because, when you look at the net asset value of a bond ETF, it's essentially made up of dealer quotes. So during times of stress, this is, I would say, not a very good way of finding the true value of a bond ETF, because if the underlying assets are not trading, that NAV is not a true reflection of the underlying assets. The price of an ETF, however, as Jimmy mentioned, that ETF continues to trade even if the underlying market is not trading at all. So the ETF, what happens is that it starts to disconnect from the net asset value. It starts trading at a discount to use its own supply and demand in order to find where the true price that buyers and sellers are willing to transact. And that's why, during a crisis, as we saw in March of last year, and also in 2008, an ETF was trading at a discount because that is the true clearing price where buyers and sellers are willing to transact. So that is a more true price discovery vehicle relative to the net asset value. So we saw this in 2008. We saw this last year as well, where heading into the crisis, the ETF will trade at a discount meaning that it's a more reflective indicator of where the underlying market is trading. And then coming out of the crisis, the price of an ETF starts trading at a premium, once again, because it is a more real-time indicator of where the underlying assets should be trading, where the NAV is kind of a more stale indicator of where prices were.
Thanks for that, Alfred. Now, really, what you're really seeing here too, of course, is that, when we talk about liquidity, can I get in, can I get out? And what you're seeing both on the equity side and the fixed income side, is Alfred just finished mentioning, the ETF kept trading, providing the access to get in and providing the access to get out of those underlying securities or basket. Jimmy, let me come to you because, we've been talking about different types of ETFs in the marketplace, but let's talk about, newer ETFs. Even we just launched some new ETFs in the marketplace. Give us your thoughts and what your role is and how do you help provide liquidity around the newer ETFs in the marketplace?
Yep. So in general, a new ETF typically, obviously has less AUM when it's initially launched. Our job is to constantly post bids and offers on that ETF, and obviously we keep a closer eye on it to make sure there's no deviations from the NAV, because really there shouldn't be any reason for that to happen. As we've mentioned previously, the only real what sets the value of an ETF is just the value of the underlyings. So any deviation from NAV should not exist. So as a market maker on a new launch, we definitely keep an eye on that. We make sure the market's in line. We constantly post prices and deep volumes as well. So really, it doesn't differ at all from a mature ETF, to the extent that you are sourcing the liquidity of the underlying asset, and that's really what matters the most.
Thanks for that, Jimmy. Now, Alfred, let me come to you because, when you launch or work on launching a net new ETF, you do your own due diligence and make sure there's liquidity in the underlying. But maybe give us some tips for the end investor here. What do they look for in some due diligence around around a new ETF?
Sure. So I think there's a number of considerations that clients should look out for. I'm not going to go through the entire list, but I think some of the ones that are more important are looking at the total AUM of the ETF provider. Reason being is that when a new ETF is launched, typically it could be a year, several years in many cases, where that ETF itself is not is not generating profit as a standalone product. But what happens is that if you have a larger ETF provider, they could essentially use their entire product shelf in order to offset losses for the newer ETFs, so they don't have to necessarily shut them down right away. The experience of the ETF provider is also very important as well. You need to look for ETF providers that have a lot of experience in managing different asset classes, because very often when you have very niche ETF providers that go into areas or asset classes that they're not accustomed to, they may not have the experience in managing those asset classes. So options is a good example where there's a lot of covered call ETFs in Canada, but do they have that experience in managing those specific asset classes? Another one I want to bring up is the relationship with index providers. Why this is important is because very often when you talk to index providers, their role is coming up with indexes that provide or that track a benchmark that is reflective of the sector or a broad market. But when you get into very granular areas of the market, the index provider may not take into account the liquidity of those specific sectors. So their purpose is coming up with an index on paper, but because as portfolio managers, we have to execute and actually trade the underlying securities, we have to have good relationships with the index providers in order to work with them, in order to ensure that there's good liquidity in the indexes that we're tracking.
Yeah, thanks a lot, Alfred. You're exactly right. It's not just a list. You want to make sure that list is liquid across the board to provide access to the inlines, the theme or the asset class, and get in and out of it. Alfred, you had brought up before that chart with a circle on there saying as ETF gets larger, there's some benefits towards that. Let's talk about that using some considerations for the large and more liquid ETFs out there and what the benefits of those are.
Yeah, so as I mentioned before, I think the more mature ETFs typically have more liquidity. When we launch an ETF, the liquidity is really determined by the underlying constituents. But as that ETF becomes more and more mature, the likelihood is that when you buy an ETF or sell an ETF of a mature ETF, you're likely buying it off of an ETF seller. So the larger the ETF, typically the more secondary volume there is, which means typically with more mature ETFs, there's tighter bid offer spreads as there's more secondary volume on that ETF itself.
Yeah, thanks for that, Alfred. And for the participants here, what are you looking at? You're looking at AUM size and then the average trading volume size itself. So you're seeing what that averagely trades for volume across the board. And this is just the Canadian ETFs, the Canadian marketplace, and scale and size there. Alfred, let's just do the exact same thing. And let's take a look at some sector-based too, because, does this cascade into sectors too, that same thought process?
Yeah, for sure it does. I would say in the sector, it's even more important as you get more and more granular in certain parts of the market. For sector ETFs, those stocks represent, typically a higher percentage or a higher weighting in that ETF. So that secondary volume becomes even more critical. So for sector-specific ETFs, I think that secondary volume and that size of an ETF becomes even more important.
Thanks for that, Alfred. And I'm going to quickly remind the audience here some quick trading tips, because as the market's moving, you always want to pay attention to some trading tips. So first and foremost, maybe think about avoiding the first 15 minutes or last 15 minutes of trading. The market maker's looking for price discovery of the underlying, so it's maybe a better chance to take a look at accessing after those periods or before they close the marketplace. I will always mention use limit orders. Great way to identify the price that you want and use those orders to get that price. And then, of course, trade when the market's open. If you think about other exchanges and other marketplaces accessing the U.S. market, trying to buy the U.S. market when it's closed and you're trying to buy it in Canada, think about that when you do that. Or the international markets, if you try to line them up in the hours they're trading. Can't always do it, of course, with emerging markets, but think about that. And then keep awareness of the market volatility out there. As market volatility picks up, quite often you can see the spreads move out a bit too. With that, one quick thing I do want to highlight before I get into the questions. We did launch some new ETFs this week, so take a look at our website. You'll see a lot new innovation in the marketplace. In fact, that's the thought process around this launch, is bringing innovation to the marketplace and getting you access towards innovation in a basket, whether it be the broad innovation themes or certain things like genomics or fintech or even clean energy for that matter. So with that, let's shift gears, get some chance to answer a few questions here. I'm going to come to you, Alfred. Certainly there's a lot more discussion on, changing policy for the new administration, a lot more focus on climate change out there. So what's your thoughts on that and maybe ways of accessing that trade?
Yeah, so, we definitely knew with this new administration that environmental, social and gender kind of, awareness was going to be a big part of his platform. So that trade has definitely been very topical as of late. So clean energy, I would say, is a good way to play this trade. ETFs specifically is a good way to get exposure to clean energy companies. So there's a number of clean energy companies available out there. We just launched our clean energy ETF, ZCLN. So tracks the same index as ICLN that trades down in the US. The difference is that ours is 5 beeps cheaper, but essentially it's a good way to get exposure to the clean energy sector, 29 different holdings within that space. But not only has it been topical with this new administration, but the World Economic Forum is also making clean energy very topical as well, which should cascade across not just the US economy, but global economies in general.
Thanks for that, Alfred. Now, of course, we're certainly seeing a lot of news this week about GameStop. Jimmy, you're on the trading floor. I think you've probably seen it still trading around there. What exactly happened this week when it came to GameStop, and hand in hand with that, why did it fizzle out on Thursday?
Definitely a very timely topic. I mean, even whoever's left on the trading floor right now, we're still looking to see like what the hell's going on. But basically, the start of it all is that there were more shorts than longs. There were the short to long on the stock was like there's more than 100% short. So definitely that's a recipe for disaster, especially in a situation where you get a short squeeze. Obviously, you can never discount herd mentality. When the opportunity of a short squeeze was pointed out on Reddit forums, people jumped on it, and as people bought more and more of the stock, the price kept going up as stock shorters kept getting squeezed out. And the beautiful part about this is, as the stock went up, people had more margin in their accounts, which they then used to buy even more stock, hence basically pushing the price higher and higher and higher. Definitely a very remarkable situation. Definitely a lesson to be learned by a lot of people. Never short more stocks than there are available. That's really the lesson there. In terms of is it criminal? I mean, I don't think so. It's not my place to judge that at all, but I don't think there's any wrongdoing with that. It's definitely, someone gave an opinion and then millions of people followed that opinion. Why did it kind of die out on Thursday? It's because basically a lot of these brokerage firms, they essentially said you cannot buy any more GameStop on margin, so you had to either buy it with actual cash that you have in your account, or you're allowed to basically close out your position. Obviously, that caused a bit of a a bit of a storm, and a lot of brokerage firms, they reversed that decision quickly.
Thanks for that, Jimmy. And Alfred, I'm going to close out with you. Just quickly, let's take that thought process, and can that happen to GameStop also happen in ETFs? And hand in hand to that, would the impact of GameStop, what's the impact of GameStop within an ETF?
So for an ETF, one thing to keep in mind is that, as I mentioned earlier in the presentation, for stock, the supply of a stock is fixed unless they do, a secondary offering. But because of that, the price of a stock is really driven by demand in the stock. As supply is fixed, it can't offset the changes in demand. For an ETF, as we alluded to during the presentation, it essentially works like a mutual fund where it's open-ended. So if there's an increase in demand, whether it's through outright buying or a short squeeze, there could be additional supply or new ETF units that could be created in order to offset that change in demand. So as a result of that, you can't, the same kind of thing cannot happen with an ETF. In terms of the second question, in terms of the impact of GameStop within an ETF, GameStop and a lot of the smaller companies that a lot of these Reddit guys were focusing on, during the week in terms of trying to create a short squeeze, most of them tended to be small cap stocks that could be easily pushed around. So because of that, they tend to be held within smaller cap ETFs only. GameStop, I looked through our ETF, tends to be it's only held in our small cap ETF, that's SML. But it's a very small holding. It's 1.1% of the ETF, so its net impact on the ETF is going to be very minimal. Keep in mind that for most of the small cap ETFs out there, they tend to be very well diversified because they are small cap ETFs. ZSML, for example, there's over 600 holdings in that ETF, so the impact of GameStop is going to be very minimal on an ETF.
Thanks for that, Alfred. And that's all the chance we're going to ask. Time we're going to have for questions this week. I'll bring up the rest of the questions next week. But for now, I want to say thank you for joining us today. Thank you to the guests too. We're going to be back next week, Friday, the 5th at 1 p.m. We're going to take the time and have a good discussion around the ETF Outlook report that we produce once a year. Our friend Mark Rays will rejoin us. Look forward to having you join us too next week, 1 o'clock. Thank you. Have a good weekend.